Okay, guys, so let us begin the topic of non-current assets held for sale, which is transactions that are basically guided by IFRS 5. Okay, so let us move on. What are non-current assets? To give you a brief overview, if an entity decides to sell an asset instead of continuing to use it, it is classified as held for sale. Now, the asset is disclosed in the statement of financial position and it has its own line item. So it has its own line item. It doesn't actually have it actually so in the statement of financial position, you're definitely gonna see a line item that is assets held for sale or non-current assets held for sale. Okay, so it's disclosed on its own separate line item, and your non-current assets that are usually reclassified as non-current asset held for sale are your intangible assets, your investment property, and your property, plant, and equipment. So, how do you value the assets that meet IFRS 5? Well, the asset needs to be recorded at the lower of the carrying amount, and you calculate the carrying amount by saying cost minus the accumulated depreciation minus the accumulated impairment, or the fair value less cost of sale. So you're gonna assess the two amounts. You're gonna find out the two amounts, and then if it's and then the non-current asset held for sale is going to be recorded between the lower of these two amounts. Okay. Now, there's something that is very important that you also need to note is that depreciation stops when the asset is held for sale. Now, what is the criteria that needs to be reached by management so that they could reclassify an asset? Well, first is that the asset must be ready for sale. The asset must be ready to sell. So the company, so we say that the asset is ready for sale if there's no major changes or improvements that you need to make before selling it. And then the second condition is that there is a high probability that the sale will occur. But how do you assess that there's a high probability that the sale will occur? Well, first you look, does management have a clear plan to sell the asset? So does management have the intention to sell the asset? Okay. If they do, then there is a high probability that the sale will occur. And secondly, the company must be actively trying to sell it at a fair market price. So, which means that the company or the entity must be making means or having efforts as to ensure that the asset is in the marketplace and that people know about it. So, we're talking about advertising costs. We are talking about them looking for buyers. All of these fall under the condition that the company is trying to actively sell the asset at a market price. Then the third requirement is that the sale should happen within the 12 months when it was classified as a non-current asset held for sale. So this is a very important point. This is a very important point. When you reclassify the asset as a non-current asset held for sale, it must be sold within 12 months. Okay? But let me give you a scenario. Let's say management wants to sell the asset, but they'll only meet the requirements at the next reporting period. Well, if that is the case, if the asset is not ready for sale or the chances of the sale happening are not highly probable, then don't classify it as a non-current asset held for sale. But this is what you actually do. What you actually do is that you don't change the financial statements, but you mention in the notes that you do have the intention of selling the asset. Okay? Let me give you an example so that you can better understand the scenario I've just given you. Okay? Now, let's say this 23 is our financial year. And in this 23 financial year, management decided to sell a factory. And the factory is what? a PPE item. But you can see that it only meets the requirements in the next reporting period, which is January 2024, because that's when the company finds a buyer and that's when the company is actively marketing the factory at a fair price. So, since the sale was not highly probable at the end of the year, then the factory stays as a PPE item in the 2023 financial statements. However, you're going to disclose in the notes that management is having the intention to sell the factory in 2024 because that is when they're going to meet the requirements of IFRS 5. But as of 31 December 2023, the asset did not meet the requirements of IFRS 5. So we could not classify it as a non current asset held for sale. Okay? Now, let's say it does meet the requirements of IFRS 5 and it has been classified as a non current asset held for sale, but it is not sold within 12 months. So what are we going to do now? Do we change the asset now because we couldn't sell it within 12 months? Do we reclassify the asset because we couldn't sell it within 12 months? Well, you don't. Because if the sale did not happen because of reasons that were outside the company's control, then continue classifying it as a non current asset held for sale. Here are the conditions for keeping the asset as a non current asset held for sale. First, the delay, like I said, is outside the company's control, meaning that some things like government approval, market conditions, these are things outside our government control. So if we couldn't find a buyer or the sale couldn't happen within the financial year because of reasons outside of our control, keep it as a non-current asset held for sale. Secondly, if the company is still trying to find a buyer, if the company is still advertising it and actively just trying to sell the asset, then continue keeping it as a non-current asset held for sale. Then the last condition is there is evidence that the sale will still occur. So all of these three things are the conditions for keeping an asset as a non-current asset held for sale. But let us look at an example so that we can understand this. Let's say a company decides to sell a warehouse, and the warehouse is a PPE item, and they find a buyer in July 2023. Okay, so the government decides to delay the approval process. This is something outside of our control, making it impossible for us to sell within the 12 months. So, since the delay is outside the company's control, and the sale is still expected to happen because we did find a buyer, then the warehouse remains as a non current asset held for sale for the reporting period ended 31 December 2023. Okay? Now, how do we classify IFRS 5? Well, the first thing you got to do is stop depreciating. Stop depreciating. Because remember, depreciating is trying to capture the use of an asset. By definition, remember, the definition of depreciation is the systematic allocation of the cost of the asset throughout its useful life. So if it's not being used, there is no depreciation. Or you stop amortization if it is an intangible asset. Okay? So, and then another thing is, once you're done depreciating, that asset, when it has been reclassified, it is no longer a non current asset in our books because we want to sell it within 12 months. We're going to put it in the statement of financial position under the section of current assets because we are expecting to sell it within 12 months. Okay? We are expecting to sell it within 12 months. And then um, remove it as a non current asset, remember, because we are no longer planning on using it and it's not going to stay there in more than one reporting period. Okay? Now, let us see how do you recognize the sale. Well, if the company now sells the asset successfully, take the following steps. First, recognize the sale transaction. And how do you do that? You record the amount from the buyer in cash, if or in receivables, and then remove the asset, because remember, you've sold it. We no longer have control, so you're going to de-recognize the asset, and then you're going to recognize the profit or loss. But how do you see that you have a profit or loss? First, if the asset is sold for more than its recorded value, then a profit is recorded. And then if the asset is sold for less than its recorded value, then a loss is recorded. But let's look at a scenario so that we can understand everything easily. Let's say entity ABC is a company and they manufacture calculators. And because they want to dominate the industry, they have decided to buy a machine that's going to make them uh, the most advanced calculators in the market. Okay. So, because now they have a new machine that makes new calculators, a new model of calculators, the old machine is not of use to them. So, on the 31st of March, the board decided to sell this old machine. And then on the next day, the entity listed the machine at Alex. Now, Alex is a website where people can buy pre used objects. And because they want to speed up finding a buyer, they advertised this machine in all their social media platforms. And because of their marketing efforts, all of this finally paid off when a potential buyer contacted the entity and a contract was signed that gave the buyer the obligation to buy on the 2nd of November. Okay, that's our scenario. Does this meet the conditions or the requirements of IFRS 5? Well, for us to assess that, we first need to see, is the asset ready for sale? And then how do we determine if an asset is ready for sale? If we don't need to make any major improvements, then the asset is ready for sale. So in this case, the asset, we are told that the asset required no changes or improvements, so it is ready. Okay. And then secondly is that there is a high probability that the sale will occur. So how do we see that there's a high probability the sale will occur? Well, if management has a clear plan to sell the asset. And how was this requirement met? It's because the board reached a resolution to sell the machine. Secondly, the company must be actively trying to sell it at a fair market price. So that means that the company listed the machine on their social media platforms and on websites. That's what the company did. So they are actively trying to sell it. So that requirement was met. And then thirdly, the sale would happen within 12 months from the time it is classified as held for sale. So here we can see that a contract was signed which obligated the potential buyer to buy the machine on that agreed date. So the sale is likely to happen within 12 months. So, because of all of these requirements being met, it is a non current asset held for sale. Now, let's look at scenario two. Let's say the buyer did fulfill his obligations, right? And they paid for the asset, um, and they bought the machine. And here we're given the information about the machine. We're being told that the cost of the machine is 1.5 million, the accumulated depreciation is 500,000, the accumulated impairment is 350,000, and the fair value less cost of sale is 600,000. Now, the company sold it for 450,000. Let us look at scenario 2. How do we recognize all these journals? Well, first, let's reclassify the asset. And when we are reclassifying the asset, we need to find out which is the lower off. And the lower off, and we need to find the lower off. So, which is lower? We're supposed to say which is lower here. Which is lower? The fair value less cost of sale or the carrying amount, which is 1.5 million minus the accumulated depreciation and minus the accumulated impairment, which gave us 650,000. Okay. Now, the fair value less cost of sale is lower than the carrying amount. So what does that mean? Remember, in impairment, if the fair value less cost of sale is less than the carrying amount, then we impair. So first we are going to impair. So let us impair. And we find impairment by saying carrying amount minus the fair value less cost of sale, and the impairment is equal to 50,000 because we said 600 minus 50,000. Then the recoverable amount is 600,000. Now, we're going to debit impairment loss. That's the first journal we're going to do. Debit impairment loss. Because remember, impairment loss is an expense. So expenses increase on the debit side. So you're going to debit impairment loss and then you're going to credit accumulated impairment loss. Why do we credit accumulated impairment loss? Because one thing that you need to remember is that an asset decreases on the credit side. And because impairment decreases the value of the asset, we credit the accumulated depreciation. And then when we classify the non current asset as held for sale, we debit the accumulated depreciation. Why? Because we are de recognizing the asset as a PPE item. So, because we are de recognizing it as a PPE item, we need to de recognize, excuse me, we need to de-recognize the the depreciations. And how do you de-recognize accumulated depreciation? You debit it because it increases on the credit side. So debit accumulated depreciation 500,000. Debit impairment loss by saying 50,000 plus the 350,000, which makes 400,000. You then gonna debit your non-current asset held for sale by 600,000. You must be asking, but how did we get the 600,000, Mta? We took the lower off because remember, our fair value less cost to sale was 600,000 and our carrying amount was 650,000. So we took the lower off, which was what? The 600,000. And then we credit machine at its cost, which is what? 1.5 million. Now, let us pretend as if the asset is sold. Excuse me. Let us pretend as if the asset is sold. What are we going to do? We're going to debit bank because we sold it for 450,000. And then we're going to debit loss on disposal because we lost money. We sold it for 450,000 when in our books it was valued at 600,000. So we made a loss of 150,000 and we need to recognize this loss. And remember, a loss is an expense, and expenses increase on the debit side. So you're going to debit loss on disposal, and then you're going to credit non-current assets held for sale. This is an indication that we are de-recognizing an asset non because remember assets de-recognize on the credit side. So that is non-current asset held for sale, its requirements, and all its journal entries. Thank you.